The debt of the US government as a percent of GDP has been rising at an alarming rate in the last few years. The United States is currently running a fiscal deficit as a percent of GDP of around 7% per year. What that means is that the debt, which is already extremely high as a percent of GDP, is actually growing at an extremely fast rate. Virtually all economic analysts agree that something has to be done about this situation because it is absolutely not sustainable. The problem is that getting the US federal deficit as a percent of GDP under control has a cost. Just as the fiscal deficit as a percent of GDP rising during the last few years helped to boost economic growth, bringing that deficit down as a percent of GDP will act on a drag on growth. Based on legislation that was already in place before President Trump was elected, and based on proposals made by President Trump and the Republican Congress, there is reason to believe that the US federal debt as a percentage of GDP is actually going to come down in the next few years, and particularly in 2025. The reduction of the fiscal deficit as a percent of GDP is going to act as a drag on the economy. And this drag is so significant that it's actually going to be a shock to the economy. And in this video, I'm going to describe in detail what sort of a shock this is going to be and how much it may actually impact the economy and the stock market in 2025. Let's start out by quantifying this problem. The US fiscal debt owed to the public as a percent of GDP is at a level of about 97%. This is a level that most experts agree is pretty much at a tipping point where if the United States actually starts accumulating debt as a percentage of GDP much higher than that, we'll reach a sort of point of no return and the US could get into a debt spiral. Now, getting the debt under control is going to be extremely difficult from where we stand right now, because as of the end of the first quarter of 2025, the fiscal deficit as a percent of GDP was running at a rate of 7% on an annual basis. Now, this 7% deficit as a percentage of GDP is the highest fiscal deficit that the United States has ever had during peacetime while the economy is at full employment. When the economy is at full employment, the fiscal deficit is actually supposed to be very low. But right now, the fiscal deficit is actually higher than it usually is when the United States is actually undergoing a recession. And that's extremely dangerous. Now let's review briefly how we got here. In order to analyze this, we need to go from before the COVID pandemic. During the first Trump administration, there was a pretty significant increase in the fiscal deficit as a percent of GDP. By the end of 2019, during Trump's first term and before the COVID pandemic hit, the US fiscal deficit as a percent of GDP had risen significantly during his term to about 4.6%. At the time, this was one of the highest fiscal deficits as a percent of GDP outside of wartime while the economy was at full employment. So going into COVID, the situation was already pretty bad. But then during COVID, as a result of trying to stimulate the economy as a result of the shock that the COVID pandemic caused to the economy, the fiscal deficit as a percent of GDP absolutely ballooned. In 2020, the fiscal deficit as a percent of GDP equaled 14.7%. Now, when a country is undergoing an economic crisis or a war, it's somewhat understandable that the fiscal deficit as a percent of GDP might rise significantly. But what should have happened is that immediately after the pandemic, the level of spending needed to decline substantially and the fiscal deficit as a percent of GDP needed to normalize back to normal levels. The problem is that that didn't happen. In 2021, despite the fact that the brunt of the COVID pandemic had already passed, the US continued to run an extremely high fiscal deficit as a percent of GDP. And then after the COVID pandemic had already completely blown by, the previous administration continued to rack up deficits, big time deficits after big time deficits in 2022, 2023, and 2024. In fact, government employment actually grew during this time at a faster rate than at almost any time since the 1960s. And government employment relative to private sector employment grew faster than it has at any other time since the 1940s. Therefore, from 2022 to 2024, instead of bringing the fiscal deficit as a percentage of GDP down to a sustainable level, which might be around 3%, we're currently at around 7% fiscal deficit as a percent of GDP. And we're sort of in a crisis situation fiscally because we have an extremely high fiscal deficit as a percent of GDP, and we're running out of time in terms of getting that deficit under control because our debt level is already pretty high. In other words, we'd have more time to get this deficit under control if the debt wasn't already so high, because we could just continue to pile up the debt until we got the deficit under control. But we just don't have that time. So it's clear that something needs to be done. Almost everybody recognizes this. Now, it's important to understand what it is that needs to be done, because a lot of people think that it's necessary to cut the budget deficit down to zero or even run some sort of a government surplus. That's not realistic, and it's not going to happen. But it doesn't need to happen, because what the United States needs to do is to simply get its deficit as a percent of GDP down. What that means is that the US can continue to run a fiscal deficit as a percent of GDP, and it can even allow the fiscal deficit as a percent of GDP to grow in dollar terms. But it has to grow at a slower rate than nominal GDP. In other words, the economy needs to grow faster than the growth of the fiscal deficit. If the economy grows faster than the growth of the fiscal deficit, then the fiscal deficit as a percent of GDP will actually go down. For example, if the fiscal deficit as a percent of GDP grows by 1% next year, let's say, but the economy grows at 4.5%, in other words, if GDP, nominal GDP, grows at 4.5%, that will actually bring down the fiscal deficit as a percent of GDP. And that's what needs to be accomplished. Now, in principle, it sounds really great, this idea of bringing down the fiscal deficit as a percent of GDP, but it has a cost, because growing the fiscal deficit as a percent of GDP has been boosting economic growth during the last few years, for example, from 2021 to 2024. Going forward, if the growth of the fiscal deficit as a percent of GDP is actually growing at a slower pace than overall GDP, then this is actually going to pull the growth rate of overall GDP downward. Now, in the long run, it's actually a good thing for the deficit as a percent of GDP to go down, for the debt levels to go down, for government spending as a percent of GDP to go down. But in the short term, and we're just talking about 2025 in this video, it's going to actually tend to have a negative impact on economic activity. So keeping these things in mind, let's try to analyze and forecast what is going to happen in 2025 and to some extent in 2026 based on what we know right now is going on. Now, in order to understand this, we need to divide the analysis into two parts. The first part of the analysis is what I call the inertial effects of the status quo. In other words, the budget that is going to be operative for most of 2025 up until September 30th of 2025 is something that was already passed by Congress and signed into law by President Biden. So pretty much nothing that occurs politically with President Trump's proposed budget, for example, is going to impact the US economy until October of 2025. So we need to sort of understand where things were already headed and where we are right now to see how this is going to have an impact on the economy for most of 2025. And then we're going to take a look at some of the specific actions that President Trump has taken in terms of his executive authority that might impact things in 2025. And there's also some things that Congress is doing that might actually impact the economy in 2025, even though it pertains to fiscal year 2026. So the first thing that I want you to understand is that based on the status quo, if absolutely nothing were to change in terms of the legislation on taxation and on spending that's running through Congress, if things simply stayed the way they were, there's actually an inertial effect right now in the direction of lowering the fiscal deficit as a percent of GDP. And as a result, this is going to tend to have an effect of pulling growth down in 2025. Now, by how much would it actually pull growth down? Well, fortunately, there's actually an organization that looks at this issue in great depth, and they've been doing it for many years, and it's a place called the Hutchins Center. And if we look at something called the Fiscal Impact Measure that's been developed by the Hutchins Center, we'll see that we are expecting a pretty substantial fiscal drag or fiscal shock on the US economy in 2025, even if nothing else happens in terms of the things that are being proposed in Congress right now and some of President Trump's own proposals. Now, we can already see this fiscal drag taking effect because during the first quarter of 2025, US government spending actually subtracted 0.63% of GDP from the GDP number. And GDP ended up being negative during the first quarter. It was actually negative 0.3. So this fiscal drag actually had a substantial impact in the first quarter already into bringing US GDP growth into negative territory. Now, the problem is that this negative effect on GDP growth, which was 0.63%, is actually going to increase substantially in the next 3 quarters of 2025. According to the fiscal impact measure, fiscal policy is going to subtract about 1.41% from GDP in the second quarter. It's expected to subtract about 1.16% in the third quarter, and it's expected to subtract about 1.25% of GDP in the fourth quarter. So overall, we're talking about a pretty big hit to GDP of about 1.3%. Now, this may not sound very much to you, but given the fact that the sort of steady, stable rate of economic growth in the United States, while it's at full employment, is around 2%, a hit of 1.3% is actually very, very substantial. Now, as I mentioned, what I just spoke about right now are the inertial effects that are being carried over from the Biden administration. But there's actually a lot of new things that are going to be happening that actually could increase this fiscal drag and this fiscal shock during 2025. And that's what we're going to focus on right now. Now, since President Trump and the Republican Congress haven't actually passed any sort of a budget, the impacts that President Trump is having on the fiscal situation is happening through his executive authority. The first major thing that has impacted the fiscal situation are the measures that he is taking under the direction of the guidance of the Department of Government Efficiency, DOGE. As a result of DOGE, there's some major budget cuts that have taken place just in the first 100 and so days of the Trump administration. In fact, if you go to the DOGE website, they claim that they've cut spending by about $163 billion. There's some controversy over whether that $163 billion is inflated. Now, regardless of what you happen to think about that, the reality is that some very real cuts have been made. A lot of you probably heard in the news that the USAID agency was essentially restructured. Practically all of its staff was fired, and the remnant was merged into the Department of State. And the total budget cuts to USAID and other international aid programs are somewhere in the neighborhood of $50 billion. So that's already a pretty substantial cut. Now, in addition to these cuts, there have been multiple cuts that have affected every single government department in the United States and agency. In fact, several agencies have been either shuttered or restructured, and every department has actually implemented some cuts that have been recommended by DOGE. So even though it may not be clear exactly how much is being cut, I think it would be very, very safe to assume that at least $100 billion are being cut, and that the impact on an annualized basis of DOGE-related cuts will be on the order of $100 billion. Now, the impact could actually be greater, but I'm being conservative in saying that the impact will be about $100 billion on an annualized basis. Now, the second major executive action that's really impacting the fiscal situation is the rise in taxes or the rise in government revenues that have come about as a result of tariffs. Now, all of you have heard about this rise of tariffs in the news, and we've recently heard that there was some agreement with China recently. But despite this agreement with China, tariffs on China are actually still very high. They're around 30%, and tariffs on the rest of the world are set at around 10%. And it seems pretty clear from what the administration has said and from the agreement that was reached with the UK that sort of the base tariff level for the entire world is going to be set at around 10%. Now, that there's going to be some exceptions on the downside where certain things are going to be exempted from tariffs. There's also going to be some sectors that are going to have much higher tariffs because they're considered to be important for national security reasons. Now, again, there's some controversy over exactly how much revenue is going to be raised by the Trump tariffs. But I think it's a pretty good conservative estimate to say that it'll probably impact the economy by at least $200 billion. So if you hit the economy with taxes of about $200 billion on an annualized basis, and you hit the economy with very, very severe and drastic budget cuts of about $100 billion on an annualized basis all at once, this actually creates a pretty big fiscal austerity program. When you consider that the US fiscal deficit is running at a rate of around $2.1 trillion, this $300 billion actually represents a pretty big chunk. We're talking about almost a 15% hit to the fiscal deficit of the United States. But the analysis can't stop here because we have to remember that currently working its way through Congress is something that Trump likes to call the big, beautiful bill. This is a bill that's going to cover so many different areas of the economy, and they're all going to try to crunch all of these different type of tax and expenditure measures and things having to do with a lot of different things into a single bill. And so when this bill finally is approved by both houses of Congress and is passed into law, then we're actually going to have a separate set of impacts that we're going to have to analyze. And truthfully, until that bill is passed into law, we're not going to know exactly, we're not going to be able to quantify exactly what sort of a fiscal drag or even a fiscal stimulus this will represent for the economy. But based on what is currently being negotiated in Congress, we have a fairly good idea of the type of fiscal impacts that we're talking about. But in particular, we have an idea about the timing of how this is going to hit the US economy. Now, the first thing that I want to talk about is that President Trump has proposed a so-called skinny budget, whereas he's proposing to freeze US federal spending, discretionary federal spending in fiscal year 2026. That runs from October of 2025 until September 30th of 2026. But this freeze in the growth of government spending, which would actually by itself represent a pretty big hit to the growth of the fiscal deficit, is pretty outstanding because the distribution of spending is going to change pretty drastically. President Trump is proposing to decrease non-defense discretionary spending by $163 billion, which is a cut of about 23%. That's a huge cut. But all of that savings is actually going to be redirected towards the Department of Defense and the Department of Homeland Security. In the case of the Department of Homeland Security, this is meant to beef up border security and also support efforts to deport illegal immigrants out of the United States. Now, it remains to be seen whether the Congress is going to approve President Trump's requests on these particular measures that would freeze discretionary government spending. But regardless of what Congress has done, President Trump has actually said that he's going to try to hold the line on government spending. And if Congress actually approves more spending than he wants for non-defense items, that he simply just won't spend that amount of money. Now, this could create some legal challenges, but the reality is that President Trump has executive authority under the concept of promoting efficiency or cutting waste and fraud, etc. As long as he's doing those things, he would be fulfilling his executive function of not wasting American taxpayer dollars on things that are considered to be wasteful. Now, in addition to these items that have to do with discretionary spending, the administration and Congress is proposing things to cut areas in entitlements. And it's actually not going to cut entitlements per se, but what they're proposing is to ratchet up some of the requirements for people that are going to receive those entitlements. And by ratcheting up some of those requirements, it'll actually bring spending on entitlements down somewhat. Trump is also proposing to raise revenue in certain ways, for example, by taxing university endowments and taxing nonprofit organizations and getting rid of certain types of deductions. And so that'll actually raise government revenue somewhat. But all of these measures designed to sort of cut spending are going to be offset by certain tax breaks that President Trump is also trying to get enacted. For example, most of you have probably heard that President Trump is trying to get approval for a proposal to eliminate the tax on overtime and eliminate taxes on tips. Now, the important thing to understand here is that the stimulative measures in Trump's proposals won't actually start impacting the economy until April of 2026. But the various the various spending cut items that he's proposed, in other words, the austerity measures that he's proposed, will actually and are already impacting the economy here in 2025. And the cuts that are proposed in the budget for fiscal 2026 will actually come into play in October of 2025. So the aspects of this budget that constitute a sort of fiscal austerity program are all being front loaded into 2025. Whereas some of the stimulus measures are actually going to hit the economy in 2026. Now, this also seems to have sort of a strategic political reasoning behind it, because President Trump and Republicans are looking forward to midterms in November of 2026. So any kind of cutting that would negatively impact the economy, they want that to hit the economy in 2025. And by the time 2026 rolls around, they want the economy to start recovering. And by mid-2026, some of the stimulus measures in terms of reductions in taxation, those measures will start flowing into the economy and boosting economic growth, so that by the time we get to November, the economy is going to feel like it's really moving compared to a very slow-moving or even recessionary 2025. So let's see if we can bring all of this together right now. Towards the beginning of the video, I mentioned that just as a matter of inertia, we can expect a fiscal drag of somewhere on the order of about 1.3% of GDP, which is pretty substantial. And some of the other things that I've discussed in this video, I think pretty conservatively might subtract roughly 2% to GDP on an annualized basis. So the total fiscal shock to the US economy, the fiscal drag, if you will be around 3.3% of GDP. That's a very, very large fiscal shock. Historically, anytime the United States has had a fiscal drag of even lesser magnitude, for example, we had this situation happen in 1990, we had it happen in 2000, and we had it in 2007. Whenever we had a fiscal drag, when the economy is kind of late in the cycle and we have full employment, that has played a pretty major role in the deceleration of economic growth that ultimately leads to a recession. And this particular fiscal drag, if I'm actually correct, and it could actually be in the neighborhood of 3.3%, more or less, that would actually be a huge fiscal drag, larger than the fiscal drags that I just mentioned to you right here. So based on how we know the economy behaves historically, it'll be really, really difficult for the US economy to avoid some sort of a recession in 2025. Now, some of you are probably asking with good reason, government spending isn't the only thing that drives economic growth. There's a lot of other factors. And if we look at those, there's not really a lot to be super optimistic about in 2025. Maybe we can be more optimistic going forward, but in 2025, the situation doesn't look all that great. For example, personal consumption actually decelerated significantly in the first quarter of 2025. And we see that consumers are actually very, very gloomy. We see this in the consumer sentiment surveys. It doesn't seem very likely to me that consumers are going to be feeling really great or any better than they are right now, because they're feeling about as bad right now as they usually feel during a recession. So this is going to tend to keep personal consumption expenditures relatively depressed, and this is going to mean that the economy is going to grow more slowly than it would have if people were in a little better mood. Now, in terms of exports, which is another aspect of GDP, I think we can pretty confidently predict that exports are going to suffer, because if we're raising tariffs on the rest of the world and they're raising tariffs on us, and also a lot of countries are simply mad at the United States and they want to buy as little as possible from us, US exports are probably going to drop off, and that's also going to tend to hurt the economy. Now, some people are optimistic about investment, and I'm actually pretty optimistic about the prospects for investment in the longer term. But in 2025, just as consumer spending is actually dropping off, as we're having issues with exports, and we're kind of going through this adjustment phase, I don't really see corporate America making huge investments and having big investment growth in 2025 that could compensate for this fiscal drag. In fact, there's some reason to believe that for the remainder of 2025, investment could be pretty sluggish for a couple of reasons. First of all, a lot of investment was front loaded into the first quarter of 2025, where investment really grew. But it really grew because businesses realized that tariffs were coming, and a lot of businesses decided to make purchases of equipment during the first quarter before the tariffs actually hit. So a lot of demand for investment equipment actually was pulled forward, which means that we'll simply have less investment in equipment in the second, third, and fourth quarters. The other thing that's going on is that interest rates are very high, and the supply of housing in many regions in the country is actually pretty high right now. So, and prices are very high. And so the demand for housing is actually kind of in the dumps right now. And so residential investment, which is a big component of investment, probably isn't going to be very vigorous during 2025. So when we look at all of the components of GDP, the fiscal side of things, which is what this video has been about, when we look at personal consumption, when we look at exports, when we look at investment, none of these things suggest that the US is going to be able to overcome a fiscal shock in the order of 3% of GDP. Now, I want to caution that this is obviously an estimate. It's possible that this fiscal shock that I'm expecting might not actually come into effect. But based on everything that we see right now, it seems that we're headed in that direction. Now, from the point of view of an investor, the problem with this is that the market is not expecting anything like a recession to happen in 2025. If you look at how stocks have risen in a record fashion in the last couple of weeks, if you look at the extremely high PE ratios of US stocks, they are reflecting extremely high expectations for growth in 2025 and going forward. And when you have high PE ratios, those high PE ratios are a reflection of expectations of high growth. But if in fact we might actually have a recession, or at least a very major economic slowdown in 2025, those growth expectations are simply not going to be met. And therefore the market is vulnerable for a big decline when those expectations are disappointed. So the question is, what do you do about this situation as an investor? Well, I can kind of tell you what I'm doing as an investor. And I have two different portfolios, and actually two different portfolio products that I'd like you to welcome to look at. And in the description, I have both of those products. I have one product which is more conservative, and one which is much more aggressive, trying to take advantage of the volatility that we're really expecting in 2025. In fact, in 2025, the volatility that we've already had has really helped me and helped our investors to do extremely well this year so far. Now, I'm actually expecting that the US market may actually continue in a relatively bullish tone, although not at the rate that it's been going in the last few weeks, but it's going to continue sort of a bullish tendency, potentially for a few weeks, because a lot of the negative impacts that I'm talking about in this video really aren't going to be felt uh, in the economy sort of right away. And it'll take a while for this to work its way through the economy and for it to be felt in the economy and for it to be reflected in economic data. In the meantime, everybody's going to continue to celebrate the fact that Trump came to this agreement with the Chinese, and it seems that what people were fearing in terms of this really negative impact on tariffs isn't going to be as bad as people thought. However, I must point out that we're still talking about a pretty big disruption in trade that's been caused by this huge rise in tariffs of 10% that's charged to the entire world and 30% to China. That is going to have its negative impacts on the economy going forward, in addition to this fiscal shock that I've discussed in this video. So what I'm saying is that the US market may continue to rise for a bit as portfolios reposition as a result of these bullish developments in the last few days with regards to China, and as the United States starts announcing other trade deals with countries like Japan, Korea, and some other major nations. But in a few weeks, maybe a couple of months, a lot of these negative factors that I discussed in this video and that I've discussed in my most recent video where I talked about the trade shock, those things are going to start to manifest in the economy. People are going to start to feel the effects of these things. And this is going to start impacting how people are feeling about the economy, how the economy is doing. And it's going to also start impacting expectations about corporate earnings growth. And at that point, I think that we're going to be heading towards another leg down in the US market, another major leg down that'll cause us to retest the lows that we had in early April. And if we have a recession, particularly if we have a relatively sharp recession, as might be suggested by this fiscal shock that I'm talking about 3% of GDP, then I think we'll actually go down below the lows of early April. Now, that's something that nobody is expecting right now, but that's a great opportunity, because if you can actually take advantage of the fact that the market is going to go down over 20% at least from where it is right now, that's a huge opportunity to really boost the absolute returns in your portfolio and to absolutely explode your relative returns. And that's what I'm going to be doing in both of my own portfolios, both my conservative portfolio and my aggressive portfolio. And I encourage you to take a look at that. So thanks very much for joining me. And we'll see you next time to do some more analysis on the US macro situation and on the US stock market and its prospects.